If a book can change the way you see the world, this is where you'll find it. I'm Karo Chen. Let's explore together the books that truly shape our destinies. Today, we're diving into Irrational Exuberance, written by Robert Shiller, the 2013 Nobel Prize winner in economics and one of the founding figures of behavioral finance. What sets Shiller apart isn't just academic theory. It's his uncanny ability to predict major market bubbles. When the first edition of the book came out in 2000, he warned that the U.S. stock market bubble was about to burst, and just 2 months later, the NASDAQ collapsed by 78%. In 2005, the second edition added a new chapter on housing, where he clearly warned about the growing real estate bubble in the U.S. a year later. The subprime mortgage crisis unfolded exactly as he predicted. What makes Shiller remarkable is that he never believed in the myth of a perfectly rational market. Using 140 years of historical data, he showed that when loose monetary policy, media hype, and herd behavior stack together, both the stock market and the housing market can easily spiral into a frenzy detached from fundamentals. And just like today, as housing regulations suppress speculative demand, capital begins flowing into the stock market in search of a new outlet. This cross-market flow of money is exactly the bubble transmission mechanism Shiller analyzes in the book. So why should we read this old book today? Because the nature of bubbles hasn't changed at all. The feedback loop Shiller describes: prices rising, confidence soaring, more buyers rushing in, and prices rising even further is being replayed again and again in today's markets. Next, we'll walk through historical bubble cases to see how the same patterns of madness repeat themselves in both the stock market and the real estate market. Only by understanding these historical medical charts can we truly make sense of the market swings we're living through now. We open this discussion by pointing out that today's capital markets are showing a kind of ice and fire split, parts of the market freezing, while others are burning hot. And even though it looks contradictory, there's nothing new about it. When you flip through the 140-year market medical record in Shiller's book, you'll see that bubbles in the stock market and the housing market have always followed the same script. Shiller's core logic is simple. Every bubble begins with a small change in fundamentals, but it grows on the back of a large-scale emotional frenzy. And only by understanding how past bubbles unfolded can we see through the shiny surface of prosperity in the market today. 1. Stock market bubbles. From rational rise to sudden collapse when it comes to stock market bubbles. One of the most iconic cases is the late 1990s U.S. market frenzy, the central example Shiller focused on in the first edition of Irrational Exuberance. And the way that boom unfolded looks strikingly similar to what we're seeing in many markets today. In January 1995, the Dow Jones Industrial Average was still hovering around 3,800 points. No one imagined that over the next 5 years it would surge all the way to 11,723 points. By January 2000, a gain of more than 200%. The NASDAQ was even more extreme. Dominated by tech stocks, it climbed fivefold between 1995 and 2000. Many internet companies had just been founded, weren't profitable yet, and their stock prices were already doubling. But when Shiller pulled up the data, the illusion of prosperity collapsed immediately. During the same period, U.S. household income rose only 28%, and after inflation, the increase was under 15%. Corporate profits grew 58%, which still couldn't justify the stock surge. It was like a store whose sales only rose by half while its valuation tripled, completely out of line with the business itself. To measure bubbles, Shiller relied heavily on the cyclically adjusted P/E ratio, price divided by 10-year average. Earnings, which smooths out short-term volatility and reveals whether stock prices are truly backed by profits. In 2000, this ratio shot up to 47.2. To put that in perspective, the only comparable period was right before the 1929 crash, when it reached 32.6, and over the past century, the average ratio hovered around 15. In other words, buying U.S. stocks in 2000 meant waiting 47 years for earnings, a loan to pay you back. instead of the usual 15. That's not investing. That's betting someone else will buy from you at a higher price. Shiller also looked at 3 historic high PE bubbles in US markets, and each one reinforced the same lesson. The higher the climb, the harder the fall. In 1901, at what people called the 20th century peak, investors were obsessed with new technologies like electric lighting and railroads, believing a new era had arrived and markets would rise forever. After the PE climbed to 25.2, stocks lost 67% of their real value over the next decade and took 20 years just to get back to the 1901 peak. Then came the 1929 crash. From 1924 to 1929, the market doubled and the PE surged to 32.6. People were borrowing wildly, and even shoeshine boys were recommending stocks to customers. In October 1929, the Dow plunged 23% in a single month and ultimately fell 80% over 3 years, not recovering until 1958. In 1966, during the Kennedy-Johnson peak, the economy looked strong on the surface and the PE hit 24.1. Investors believed the government could stabilize everything and the market wouldn't fall. Yet, over the following decade, stocks lost 56% of their real value and didn't return to their 1966 level until 1992. At this point, many people might ask, with China's Shanghai Composite rising 40% in half a year, does that count as a bubble? Using Shiller's method, the overall A-share PE ratio is around 18, below the historical average of about 20. But in certain hot sectors like AI and new energy, valuations have already pushed past 50, which looks very similar to US tech stocks in 2000. People are betting on the future and ignoring present earnings. Shiller repeatedly warns that short-term rallies aren't dangerous. What's dangerous is when earnings lag while emotions take off. Every stock bubble in history began with a local hot spot and gradually expanded into full market madness. 2. Real estate bubbles. Don't believe housing always goes up. The data says otherwise compared with stocks. Ordinary people are much more sensitive to housing bubbles because homes feel safer and more essential. Many believe buying property is less risky than buying stocks. But Shiller used U.S. housing data from 1890 to 2004 to shatter that belief. After adjusting for inflation, real home prices in the U.S. rose only 66% over 114 years, an annual gain of just 0.4%, less than what a bank deposit could earn. The idea that home prices always go up was nothing more than a collective illusion formed during bubble periods. The global housing boom after 2000 was a major focus in the second edition of Shiller's book, and it shared striking similarities with the past decade of China's housing market. After the U.S. stock crash in 2000, excess capital flooded into real estate. The median U.S. home price jumped from $143,600 in 2000 to $219,600 in 2005, a 53% rise in just 5 years. In cities like Hong Kong, London, and Sydney, inflation-adjusted home prices rose more than 70% from 2000 to 2004. The justifications people used were also eerily familiar. Population growth, limited land, ongoing urbanization, and supportive policies. But Shiller quickly spotted the cracks in the narrative. First, home prices were rising far faster than incomes. From 2000 to 2004, U.S. per capita income rose only 15%. While home prices soared 53%. The price-to-income ratio jumped from 4.9 to 7.7, meaning the average family would need 7 years of no food, no expenses just to buy a house, clearly beyond affordability. Second, bubbles were highly local, not nationwide. Cities like Boston and Los Angeles soared, while Cleveland and Milwaukee barely moved, because those markets had no speculative stories. Only genuine housing demand. Third, the idea of land scarcity was a myth. Shiller calculated that urban land made up only about 2.6% of U.S. territory. Most land was still farmland or forest, and zoning policies, not land itself, limited new housing supply. We all know how this bubble ended. In 2007, the subprime mortgage crisis hit. Home prices fell 30% from their 2006 peak, and about 1.3 million families lost their homes to foreclosure. The global economy was dragged into recession. Shiller lamented that if people had looked at history, they would never have believed that home prices rise forever. Any price level inflated purely by speculation eventually returns to fundamentals like household income and construction costs. Looking at today's Chinese housing market, the same logic applies. In the past decade, cities like Shenzhen and Hangzhou saw prices increase 3 to 5 times, with price-to-income ratios exceeding 20, far above the U.S. bubble level of 7.7. The recent price declines don't mean the housing market has failed. They simply signal a return to fundamentals. Shiller reminds us that the true purpose of housing is living, not speculation. When buying a home becomes a pure bet on future price increases, it's no different from gambling in the stock market. Housing bubbles burst slowly, but when they do, they fall harder and affect more people. After looking at the medical records of both stocks and housing, we can draw two key conclusions, which naturally lead us to the next part of Shiller's framework, the ignition factors of bubbles. First, all bubbles share the same genetic pattern. They begin with small fundamental tailwinds, technological advances, loose monetary policy. Then the media amplifies the story. Money pours in, emotions run wild, and prices detach from value. Second, bubbles are never random. Every stock market bubble was preceded by capital looking for a new home. Every housing bubble was fueled by easy credit and nationwide speculation. These aren't coincidences. They reflect a deeper set of structural forces. In the next part, we'll break down these structural forces, including the 12 bubble spark plugs Shiller identified, such as the Internet revolution, Alan Greenspan's loose monetary policy, and the mass adoption of mutual funds. These factors stacked together are what turned small sparks into historic firestorms. And understanding them helps explain why money is now leaving China's housing market and flowing into stocks. At its core, it's simply the search for the next speculative outlet, almost identical to the shift from U.S. stocks to U.S. housing after the 2000 crash. In the last section, we reviewed the patient files of the stock and housing markets and found that whether it was the U.S. stock market crash of 1929 or the subprime mortgage crisis of 2007, the end of a bubble is always that the faster it surged, the harder it crashed. But merely knowing the result is not enough. We must understand the process. Why does a healthy market gradually spin out of control? Shiller argues that a structural framework must underpin this process. First, 12 triggering factors set the stage. Then amplification mechanisms allow the bubble to snowball. Without this framework, no matter how frantic the emotion, it can't lead to a major bubble. Today, we're going to deconstruct this framework to see how it turns small positives into large bubbles. This will also help us understand the current capital logic in the Chinese market. Why is housing market capital shifting into the stock market? Essentially, this framework is at work. Shiller listed 12 structural factors that drive bubbles in his book. It's not that each factor can trigger a bubble alone, but rather they act like dominoes, falling one after another and ultimately pushing the market into a frenzy. We will select a few of the most critical factors and those most relevant today. You'll find echoes of these factors in today's Chinese market. Factor 1, the market economy and the ownership society. Everyone wants to be an investor boss. Let's start with the big picture. Since the 1980s, the world has promoted the market economy, and the U.S. even championed the slogan of an ownership society, meaning everyone should be a property owner, making money not just from labor, but also from stocks and real estate. How is this asset appreciation realized? Companies encourage employee stock ownership, offering things like stock options. The government promotes the 401k retirement plan, where employees can choose to invest in stocks or bonds themselves. Even labor unions rarely prioritize protecting workers' wages anymore, switching instead to helping members secure more ownership opportunities. The impact of this logic is direct. People used to think investing was for the rich. Now they feel like they're losing out if they don't invest. Shiller found that in 1983, only 16.5% of private sector employees in the US belonged to a union, dropping to 9% by 2000. By 2003, employees with stock options accounted for 11% of the private sector workforce. People's identity shifted from that of a worker to a small shareholder. Naturally, they became more concerned with market fluctuations and more willing to put money into the market. In China today, the atmosphere of national financial management has become increasingly intense in recent years. The number of mutual fund accounts surged from 120 million in 2015 to 600 million in 2024. Many companies also implement employee stock ownership plans. Even recent graduates know they should dollar cost average and allocate to equity funds. This mindset of everyone is an investor forms the mass base for the bubble. When everyone feels they lose by not investing, capital flows continuously into the market, setting the stage for a bubble. Factor 2, the new technology revolution. The "this time is different" illusion. Before nearly every bubble, new technology serves as a facade. Automobiles and radios in the 1920s, the internet in the 1990s, and smartphones after 2000. Shiller says new technology is inherently positive, but it creates the "this time is different" illusion, leading people to believe that technology can defy economic laws and that companies will profit forever. This illusion was most obvious in 1995 with the advent of the World Wide Web. People thought the internet would revolutionize everything. A company, even without earnings, could see its stock price double just by having a .com nameplate. Shiller reviewed the data. Actual profit growth for U.S. tech companies was 36% in 1994, then 8% in 1995, and 10% in 1996. Profit growth was actually slowing, but stock prices rose even faster because people believed future profits would explode. More interestingly, many traditional companies, such as those selling socks or running restaurants, would see their stock price rise 20 to 30% simply by announcing a shift to the internet, regardless of whether the transition succeeded. Aren't new technologies like AI and new energy in the Chinese market today repeating this logic? From 2023 to 2024, any stock connected to AI, even if losing money, could double in price. New energy vehicle makers, despite clear overcapacity, see their market values soar just by talking about smart driving technology. Shiller reminds us that while new technology improves efficiency, it will not allow companies to escape the need to make a profit. Less than 10% of the automobile companies from the 1920s survived, and 80% of the internet companies from the 1990s failed. The survivors, like Amazon, only justified their market value through years of profitability. Factor 3. Loose monetary policy, the aftermath of the Greenspan put. Loose monetary policy often acts as the catalyst for bubbles. Shiller specifically criticizes former Federal Reserve Chairman Alan Greenspan. Although he warned of irrational exuberance in 1996, he didn't truly tighten policy. Instead, every time the market fell, it would cut interest rates to backstop it, a strategy known as the famous Greenspan put. The most typical example, after the 2001 U.S. stock market crash, Greenspan cut rates from 6.5% to 1.75%, and even to 1% in 2003, one of the lowest rates in U.S. history. Money became very cheap, lowering the cost for people to borrow money for housing and stock speculation, directly inflating the real estate bubble. Shiller calculated that from 2001 to 2004, U.S. mortgage interest rates dropped to 5.8%, which was much lower than the 18% of the 1980s. Ordinary people could easily leverage up to buy homes, and mortgage volume increased by 60% in 5 years. This logic can be seen in China today. Since 2023, the People's Bank of China has repeatedly cut reserve requirement ratios and interest rates, and mortgage rates have dropped below 4%. Stock trading commissions are also falling. As money becomes cheaper, a portion of the capital exiting the housing market rushes into the stock market looking for opportunities. Shiller warned that loose policy is like a narcotic. It stabilizes the market in the short term, but long term, it creates a dependency on the government will bail us out if it falls, making people take bigger risks and ultimately blowing up the bubble. Factor 4. Popularization of investment tools. Mutual funds allow non-experts to enter the market. For a bubble to grow, it needs support from massive amounts of capital, and the popularization of investment tools is key to aggregating retail capital. Shiller notes that the U.S. had only 340 mutual funds in 1982, but that number surged to 3,513 in 1998, more than the number of stocks listed on the New York Stock Exchange. The number of fund accounts grew from 6.2 million in 1982 to 164 million in 2000. Almost 2 fund accounts for every household. Why is this critical? Before, buying stocks required finding a broker and understanding financial statements, which ordinary people wouldn't dare to touch. But mutual funds said, we'll choose the stocks for you. You just invest and we'll diversify your risk. This allowed non-experts to enter the market. Shiller's survey in 1999 found that 67% of fund investors said they bought funds for the peace of mind, while only 23% understood the stocks the fund held. The problem is that when everyone enters the market through funds, capital rushes in blindly. Whatever the fund buys, retail investors follow, thereby pushing up hot stocks and forming a bubble. Isn't the Chinese fund market the same today? The size of equity funds exceeded 15 trillion. CNY in 2024. Many new funds with an AI or new energy label sell out in a single day. But the same blindness Shiller observed is present. Many people only look at last year's returns, ignoring the fund manager's competence or whether the holdings have a bubble. This is identical to the logic of U.S. retail investors in the 1990s following the trend, providing financial ammunition for the bubble. Beyond these 4 factors, several others also fueled the fire. For example, the rise of gambling culture. Legal gambling expenditure in the U.S. rose 60 times between 1980 and 2000. People became more tolerant of high risk, high return, treating stock trading like buying a lottery ticket. Win, you profit. Lose, you accept it. Another example is tax incentives. In 1997, the U.S. capital gains tax rate dropped from 28% to 20%, and then to 15% in 2003. People felt that making money from stocks was more worthwhile because they paid less tax. There's also media hype, which we will discuss in depth in the next part. For now, let's just mention that financial channels like CNBC were broadcasting stock news 24 hours a day, constantly showcasing fund managers who made 10 times their money, further stimulating the public's speculative appetite. These 12 factors together built the bubble's framework. The market economy provided the mass base, new technology provided the story, loose policy provided the money, and fund popularization provided the funding channel. Lacking any one of them, the bubble couldn't gain momentum, but when they converged, the bubble turned from a small spark into a massive conflagration. Having the framework isn't enough. For the bubble to grow, it needs amplification mechanisms, like a snowball that needs wind to keep rolling and getting bigger. Shiller says this wind is the Ponzi process and the feedback loop. They are not deliberate scams, but naturally occurring self-reinforcing mechanisms in the market. First, let's discuss the Ponzi process, or filling old holes with new money. Mentioning Ponzi makes people think of the Ponzi scheme, where money from new investors is used to pay returns to old investors. But Shiller says the Ponzi process in the stock and housing markets is natural. No one is deliberately cheating. Instead, rising prices naturally attract new capital, which in turn pushes prices higher, creating the illusion of a virtuous cycle. The most typical example is the U.S. stock market in 2000. One person makes money buying stocks and tells a friend. The friend buys and profits and tells a colleague. The colleague profits and tells a relative. New capital continuously flows in, pushing up prices. Old investors see the profit effect and are even less willing to sell, so prices rise even higher. Shiller found that in 1999, the average holding period for U.S. retail investors dropped from 5 years in the 1980s to 1 year. Everyone was trading in and out quickly for the price difference, essentially relying on new money to take over. The U.S. housing market in 2005 was even more evident. Prices rose, owners felt their homes were worth more, so they refinanced their homes to buy second or third properties. New buyers saw prices rising faster than mortgage interest and also borrowed money to buy. The continuous influx of new mortgage capital pushes up housing prices, creating a cycle of you can make money just by buying a house. Shiller calls this the natural Ponzi process. It involves no complex scam, just the profit effect attracting new capital. And the new capital is sustaining the profit effect until there's no one left to take over. Isn't the current craze for new stock IPOs and trend chasing in the Chinese stock market the same logic? When a new stock is listed and has continuous limit up days, people think IPO subscription is a guaranteed profit and subscribe frantically. When AI stocks rise, people think buying AI means profit and follow the trend. New capital keeps driving up hot stocks until the trend cools and the bubble bursts. Next, let's talk about the feedback loop, the mutual hostage situation between emotion and price. The core of the amplification mechanism is the feedback loop, from rising prices to optimistic sentiment, to more people buying, to prices rising again. Emotion and price become mutually dependent, sinking deeper and deeper. Shiller uses the 2000 U.S. stock market as an example to break the feedback loop into 3 steps. Step 1, price rises, confidence increases. From 1995 to 2000, U.S. stocks rose 20 to 30% annually. Everyone felt the stock market was in a TM machine, and confidence soared. Shiller conducted a survey. In 2000, 97% of high-income investors believed that holding stocks long-term could make money, with 67% fully agreeing. This was much higher than the 50% seen in 1989, showing confidence was completely ignited by rising prices. Step 2. Confidence increases, more people enter the market. With confidence high, people were willing to put more money into the stock market. In 1995, U.S. resident stock holdings accounted for 23% of their wealth. By 2000, that rose to 45%. Even retirees shifted their pensions from bonds to stocks, believing stocks offered higher returns. Step 3. More people enter the market, prices rise again. The influx of capital pushes up stock prices, and rising prices further boost confidence. This loop spins faster and faster until prices are completely detached from earning support and become purely emotionally driven. Shiller specifically warns, the feedback loop doesn't just cycle in a single market. It transmits across markets. After the 2000 U.S. stock market crash, capital moved from stocks to the housing market, fueling the real estate bubble. After the 2007 housing market crash, capital shifted to commodities, such as oil and gold, fueling a commodity bubble. The current situation in the Chinese market following housing prices and rising stock prices is essentially a cross-market feedback loop. The profit effect disappeared in the housing market, and capital shifted into the stock market, forming a new feedback loop. After examining the 12 triggering factors and amplification mechanisms, we can understand a key piece of logic which naturally connects to the next part about cultural factors. Structural factors are the bubble's framework, but the framework alone is not enough. There must be cultural soil for emotions to take root and flourish. For example, why did the new technology revolution convince everyone that this time is different? Because the media was constantly hyping up the tech myth. Why did loose policy encourage people to use leverage? Because new era thinking made people believe the economy would always be strong. These are all cultural factors at work. In the next section, we will deconstruct these cultural factors. How do news media amplify emotions? How does new era thinking brainwash people? How do global bubbles spread? It is the structural framework combined with the cultural soil that turned historical bubbles from small fluctuations into major crises. and understanding them is essential to truly grasping the frenzy of the current market. Is the rise in the Chinese stock market supported by fundamentals or driven by emotion? Is the drop in the housing market a short-term adjustment or a bubble correction? These questions require the lens of cultural factors to see through. In our previous section, we dissected the structural framework of the bubble, the 12 triggering factors that provided hard conditions and amplification mechanisms, allowing the bubble to snowball. But hard bones alone are not enough. Just as a seed needs soil to grow into a tree, the cultural soil of a bubble consists of the soft factors that distort perception and ignite emotion. How do news media inflate a small positive into a grand myth? How does new era thinking convince everyone that this time is different? And how does global culture allow bubbles to spread across countries? Without this cultural structure, even the most complete framework struggles to generate mass public frenzy. Today, we're going to dig into this cultural soil. You'll find that the current excitement in the domestic stock market and the cooling in the housing market are both being fueled by cultural factors. These cultural influences ultimately impact human psychology, which perfectly sets up the next section on the human roots of bubbles. Part 1. News media. The sentiment amplifier of the bubble Shiller spends considerable space in his book discussing the media. Not because they are the puppet masters, but because they are the megaphone for emotion, turning niche speculative sentiment into nationwide frenzy. Many people believe the media merely reports the news objectively, but Shiller uses historical data to prove that the media is never neutral. It selects hot topics, crafts narratives, amplifies anxiety, and ultimately lets market sentiment spiral out of control. The media's survival logic is to pick eye-catching stories. To survive, the media must attract readers. Dull, unexciting fundamentals don't get views. Sensational bubble stories are what people want. Shiller observed that during the US.com bubble of the 1990s, the reporting logic of US financial media like CNBC and the Wall Street Journal completely changed. Previously, stock market reports would discuss company earnings and industry policy. During the bubble, the media only focused on wealth creation myths. For example, a 25-year-old programmer's startup going public, making them an instant millionaire, or a fund manager earning 10 times their money in a year. These stories had 10 times the click-through rate of dry financial data. The media used to balance bullish and bearish views, but during the bubble, they published almost exclusively bullish comments. Bearish experts were labeled as being out of touch with the new era. For instance, in 1999, economists who warned the dot-com bubble would burst were mocked by the media for not keeping up with technology trends. The media would even manufacture buzz, such as giving tech stocks nicknames, like calling Netscape the king of the internet, or Amazon the e-commerce disruptor. They tracked stock prices daily, turning the stock market into a reality show. CNBC had a program called Mad Money at the time, where the host would use exaggerated gestures to promote stocks, drawing much higher ratings than serious financial programs. This same logic can be seen in domestic financial media today. During the AI craze in China's share market in 2024, many media outlets constantly reported that a certain AI company's orders had exploded or that AI fund sizes had surpassed 100 billion. But they rarely mentioned that these companies were still losing money. Despite overcapacity in the AI sector, videos of street interviews with retail investors went viral, mostly showing people who made 2 months' salary by buying AI stocks, with no voice given to those who lost money. Shiller says this isn't because the media is evil. It's because survival pressure forces them to act this way. The audience gets what they want, and during a bubble, people only want to hear success stories. Eventually, the media and the audience reinforce each other, driving sentiment to extremes. Even more alarming, Shiller found that days with major stock market price movements often have no corresponding major news. Instead, the media packages trivial information into major events, amplifying market volatility. The most classic example is before the 1929 U.S. stock market crash. On October 28th, Black Monday, the Dow dropped 12.8%. But what were the main headlines in the newspapers that day? The Interstate Commerce Commission was pushing the Railroad Revenues Act. Mussolini gave a speech claiming fascism could handle the crisis. These were insignificant details, but the media interpreted them as bearish signals. The New York Times, for example, suggested the railroad bill might affect corporate profits and intensify investor anxiety, artificially blowing a minor event into the trigger for a crash. The same thing happened before the 2007 U.S. subprime mortgage crisis, when housing prices only dropped 2% in August. The media dug up historical headlines from the 1929 crash, using housing market collapse to warn the subprime crisis is coming, terrifying investors into panic selling. What should have been a minor correction became a major crisis. Shiller calculated that on the day of the 1987 U.S. stock market crash, there was no major negative news, yet the media repeatedly mentioned the 1929 crash, causing panic to spread. The Dow dropped 22.6% that day. This is the media sentiment amplification effect. Even without news, simply digging up bad news from history and linking it to the present can ignite panic. Conversely, during a bubble, digging up historical good news can ignite optimism. Applying this to the current domestic market, when the A-share market hypothetically hits 3,800 points in 2025, are there times when it rises without good news? Absolutely. For example, the Shanghai Composite Index might rise 2%, but the only news that day involves routine matters, like the central bank fine-tuning monetary policy or an industry holding a symposium. The media, however, interprets this as policy is being deployed. The bull market is here, further driving up sentiment. Shiller warns us to be careful when reading media reports. If the swing in prices is large but the news is routine, it's very likely emotion is dominating, not fundamentals. During a bubble, the media has another bad habit, selective memory. They only talk about past rallies and ignore past crashes, making people feel the stock market always goes up. Shiller found that during the 1990s U.S. bubble, the media rarely mentioned the 50% drop in U.S. stocks from 1973 to 1974, the 1987 crash. They only talked about the great bull market from 1982 to 1999, giving the audience the illusion that the stock market only rises. Domestic media today has a similar tendency. When discussing the stock market, they always mention the bull markets of 2005 to 2007 and 2014 to 2015, but rarely the major crashes of 2008 and 2018. When talking about the housing market, a few years ago they only mentioned Shenzhen home prices rising fivefold in a decade, but they don't mention the 20% drop now. This selective memory leads newcomers to mistakenly believe that profiting is the norm and losses are accidental, ultimately causing them to blindly follow the crowd. Part 2. New Era Thinking, the opium for the bubble's spirit. If the media is the sentiment amplifier, then New Era Thinking is the bubble's virtual opium. Every bubble is accompanied by a self-justifying theory that convinces people that this time is different, and the bubble will never burst. Shiller says this thinking is not deliberately invented. It evolves naturally from the market. Its essence is using future imagination to mask the current bubble. Shiller's research on nearly a century of bubbles shows that the pattern of new era thinking has never changed. It always treats new technology or new policies as a get-out-of-jail-free card, claiming that new variables make old rules irrelevant. During the 1920s U.S. stock bubble, when cars and radios became popular, people said new technology could eliminate the economic cycle and corporate profits would always rise. The result, the 1929 crash with profits falling 50%. During the 1990s dot-com bubble, when the World Wide Web emerged, people said the internet would revolutionize traditional industries, and high PE ratios were normal. The result, the 2000 bubble burst, with 80% of internet companies failing. During the global housing bubble after 2000, People argued that urbanization plus population growth and land scarcity meant housing prices would always rise. The result, the 2007 subprime mortgage crisis, with home prices falling 30%. This pattern is repeating now. With the AI boom in China's A share market from 2023 to 2024, many people are saying AI is the fourth industrial revolution and will restructure all industries. So buying AI stocks now is buying the future. But Shiller long ago debunked this logic. New technology does create value, but it will not allow companies to escape the need to make a profit. Cars were new technology in the 1920s, yet less than 10% of those companies survived. The internet was new technology in the 1990s, but only a few companies like Amazon and Google eventually justified their market value with earnings. The same is true for AI today. Most companies are just riding the trend without any earnings support, and eventually they will all revert to fundamentals. The most deceiving aspect of new era thinking is this: the premise is correct, but the conclusion is wrong. Take the economic recovery theory in the current Chinese stock market. The premise is that the domestic economy is recovering and corporate earnings will improve. That's correct. But the conclusion is, therefore, the stock market will keep rising. And there's no need to fear correction. That's wrong. Shiller says there is no necessary linear relationship between economic recovery and stock market rises. The U.S. economy recovered in the 1990s and stocks rose, but when the economy recovered in 2001, U.S. stocks fell. When the Chinese economy recovered in 2010, the A-share market fell. Whether the stock market rises depends on whether expectations have been priced in already and whether sentiment is overheated. Another example is the essential demand theory for housing. The premise is that Chinese people need to buy houses for marriage and retirement. That's correct. But the conclusion is, therefore, housing prices will always rise. That's wrong. Shiller found that essential housing demand was stronger in the US and Japan than in China. Yet their housing prices still crashed. When buying a house becomes speculation, essential demand cannot support the price. Ultimately, it must revert to fundamentals like resident income and construction costs. Shiller repeatedly emphasizes in his book that historically all new eras eventually became old eras. The new technology era of the 1920s became the Great Depression era 10 years later. The internet era of the 1990s became the bubble burst era 2 years later. The housing market era after 2000 became the subprime crisis era 7 years later. Why? Because the essence of new era thinking is emotional self-comfort. When prices decouple from fundamentals, people need a theory to convince themselves that they haven't bet wrong. New era thinking is that theory, but emotions always cool down. When earnings don't keep up and capital recedes, the theory fails and the bubble bursts. The current Chinese market is the same. Whether it's the AI new era or the stock market recovery new era, as long as it deviates from fundamentals like corporate earnings and resident income, it will eventually return to rationality. Part 3. Global Bubble Contagion. The cross-market virus of culture bubbles don't just stay in one market. They become global epidemics through cultural contagion. Shiller found that the global tech stock bubble of 2000 and the global housing bubble of 2007 both started with one leading market, and other markets followed in a frenzy. This is more than simple capital flow. It's crucially about cultural contagion. When people see foreign markets rise, they assume their domestic market will follow, ultimately leading to globally synchronous bubbles. The core of cultural contagion is psychological imitation. Through media reports, foreign bubble narratives become replicable templates that domestic investors follow. For example, during the 2000 US .com bubble, the US media reported on internet companies going public and creating wealth, and Chinese media followed suit, reporting that Chinese internet companies were also planning US listings. When US retail investors made money buying tech stocks, Chinese retail investors followed, buying A-shares with internet concepts. Eventually, when US tech stocks fell, related Chinese stocks fell too. This is cross-market imitation. This contagion is even more pronounced today. When US AI stocks rise in 2024, Chinese media report that the US AI boom is sweeping the globe, and Chinese retail investors follow by buying A-share AI stocks. When Tesla's stock price rises in the US, Chinese new energy vehicle company stocks also rise, even if the profitability of Chinese companies lags far behind Tesla's. Shiller says this is because globalized media makes bubble stories borderless. When people see the profit effect abroad, they assume it can be replicated domestically, ultimately forming a globally synchronized emotional cultural contagion. The scariest thing is ignoring local differences, directly applying foreign bubble logic to the domestic market, regardless of whether the fundamentals are different. For example, during the 2007 global housing bubble, U.S. home prices rose due to low interest rates and subprime lending, while Chinese home prices rose due to urbanization and speculative capital inflow. The logic was different. But the media only reported that global housing markets are all rising, so everyone assumed Chinese home prices would also rise forever. When the bubble burst, they discovered the U.S. subprime crisis and the Chinese housing market were fundamentally different, but the emotional contagion was the same. The current Chinese stock market also carries this risk. Seeing U.S. tech stocks rise, people assume A-share AI stocks will follow, ignoring that U.S. tech stocks have earnings support while many A-share AI stocks are losing money. This blind imitation will only make the bubble burst harder. After reviewing the three major cultural factors, the media, new era thinking, and global contagion, we can draw a key conclusion. The core role of cultural soil is to influence human cognition. The media makes people focus only on success stories. New era thinking makes them believe this time is different. Global contagion makes them blindly imitate. These ultimately impact individual psychology. For example, media reports lead to herd behavior. New era thinking leads to overconfidence. Global contagion leads to risk ignorance. These are the human roots we will discuss in the next section. In the next part, we will dissect these human factors, focusing on Shiller's analysis of psychological anchoring and herd behavior. Why do we treat the most recent price as the fair price? Why do we follow others when buying stocks? Understanding these points will reveal that the essence of a bubble is a collection of human weaknesses. The cultural soil merely amplifies these weaknesses, and only by understanding human nature can we truly avoid the traps of the bubble. In our previous section, we discussed the cultural soil of bubbles, how the media amplifies emotion, how new era thinking brainwashes, and how global contagion pushes the market into a frenzy. But have you ever wondered why these cultural tactics actually work? Essentially, it's because they strike at human weaknesses. Shiller points out sharply in his book that the core of a bubble isn't policy or capital, but human cognitive bias. We are innately prone to anchoring to the wrong price and following the crowd, and culture merely amplifies these human flaws. In this part, we'll dig into the human roots of bubbles, how psychological anchoring makes us misjudge value, and how herd behavior makes us blindly follow the trend. Once you understand this, you'll realize that the current AI craze in China's stock market and the previous lottery-style home buying frenzy aren't signs that the market has gone crazy. It's a collective explosion of human weaknesses. Part 1. Psychological anchoring, how we clumsily set the wrong prices. Shiller says psychological anchoring is the most easily overlooked bias in human nature. When we judge the worth of a stock or a house, we don't base it on fundamentals, but on a psychological anchor. This anchor might be the most recent price, the judgment of others, or even a feeling of moral correctness. It is this misplaced anchoring that makes us feel that expensive is right during a bubble. The most common anchoring bias is quantity anchoring. We subconsciously treat the most recently observed price as the reasonable price, fixing our judgment just like an anchor. Shiller offers a classic example. Before the 1987 U.S. stock market crash, the Dow index was fluctuating around 2,200 points. People felt 2,200 points was normal. But on the day of the crash, it fell to 1,700 points. Many felt it had fallen too much and it was time to buy the dip, forgetting that the Dow was only 800 points in 1982. This 2,200-point anchor caused people to misjudge the true value. Shiller conducted a more telling experiment, asking investors, "Do you think the current stock market is expensive?" 80% answered that they primarily looked at recent conditions. If it had recently gone up, they thought it was expensive. If it had recently fallen, they thought it was cheap. Almost no one mentioned fundamentals like PE ratios or earnings. This is human laziness. It's much easier to use the recent price as an anchor than to calculate complex financial data. Yet, it is precisely this laziness that drags us deeper into the bubble. More subtle than quantity anchoring is moral anchoring. We regard buying stocks or houses as a symbol of being responsible and insightful, even feeling that not doing so is wrong. This moral coercion turns investment from a rational decision into an emotional choice. Shiller's survey during the 2000 U.S. stock bubble found that 72% of high-income investors said that long-term stock holding was the smart person's choice. 43% felt that not buying stocks was irresponsible to their family, as if not participating in the market meant they lacked ability or foresight. This moral anchoring is even more obvious in the housing market. When the Chinese housing market was hot, it became a consensus that you must buy a house for marriage. Men without homes were seen as lacking responsibility, and renting for marriage was considered unreliable. Parents would urge their children to buy quickly before prices rose further, linking homeownership with being responsible for their children's future. Some young people even felt that if everyone else was profiting from rising home values, they were losing out by not buying, treating not buying a house as a sign of failure. The essence of this moral anchoring is the conformity, complex, and anxiety about social evaluation inherent in human nature. We fear being seen as outliers or being called ignorant. Thus, even if we suspect housing or stock prices are in a bubble, we follow suit. Shiller lamented that when investing becomes morally correct, rationality loses its foothold. For instance, during the 2000 U.S. stock bubble, some people bought internet stocks despite knowing the companies weren't profitable, simply because not buying would make them a laughingstock among colleagues for not understanding technology. There's another major bug in psychological anchoring: overconfidence. Shiller found that both professional investors and retail investors believe they are better than others. In his 2000 survey, 82% of retail investors believed their stock picks would beat the market, but fewer than 5% actually managed to do so. Even among fund managers, 70% thought their stock picking ability was superior to their peers, but long-term, most funds fail to beat the index. Why does this happen? Shiller says this is the human self-enhancement bias. We are always willing to believe our own judgment is right, ignoring the role of luck and the market. It's like feeling you're skilled when you win a card game, but blaming bad luck when you lose. When investing profits, it's attributed to good vision. When it loses, it's blamed on a bad market. This overconfidence makes us dare to use leverage and chase high prices during a bubble, leading to ever greater losses. Part 2. Herd behavior. Why do we always follow others? If psychological anchoring is self-deception, then herd behavior is being deceived by others. We are naturally inclined to follow the majority, assuming that what everyone else is doing must be right. Shiller uses psychological experiments and market data to prove that the essence of a bubble is a collective explosion of herd behavior. Without conformity, there is no mass frenzy. To understand conformity, we must mention the oft-cited Asch conformity experiment. In 1952, psychologist Solomon Asch ran an experiment with 8 participants, 7 of whom were Confederates, and only 1 was the real subject. The experiment was simple: show everyone a 10-centimeter line segment, then show 3 other lines of different lengths, and ask which one is the same length as the 10-centimeter line. The answer was obvious, but the 7 Confederates deliberately gave the wrong answer. The result? 33% of the real subjects followed suit and gave the wrong answer, not because they misjudged, but because they feared being isolated. This experiment struck at a core human vulnerability. We fear isolation and being different from the group. Applied to investment. If everyone else is buying iStocks, I must be stupid if I don't. If everyone is lottery buying homes, I will lose out if I don't buy. Shiller's survey before the 2007 subprime mortgage crisis found that 62% of families who took out subprime mortgages said they did so because their neighbors were doing it. They knew their income was insufficient but still followed the crowd, fearing exclusion from the money-making group. Herd behavior doesn't happen suddenly. It is the result of an information cascade. The first person buys. The second person assumes the first might have inside information and also buys. The third person sees the first two buying and also buys. In the end, everyone has bought the wrong thing, but no one knows why. Shiller gave a vivid example. Two adjacent restaurants. A is crowded, B is empty. The first customer randomly chooses A, the second customer sees A as busy and assumes A must be good, so they choose A too. The third customer sees the first two choosing A and follows suit. Eventually, A is packed and B is empty, when in fact, the taste is about the same at both. This is an information cascade. We always assume that others' choices are rational, forgetting that others might also just be following. Shiller says the frightening part of an information cascade is that no one dares to question it. Everyone assumes so many people can't be wrong, and even if they have doubts, they dare not speak up. Just like during the 2000 US stock bubble, economists who questioned the profitability of internet companies were accused of not understanding the new era. Eventually, no one dared to tell the truth, and the bubble kept growing. Herd behavior spreads through word of mouth. Compared to financial data in a newspaper, the profit stories from friends and colleagues are far more persuasive. Shiller's data during the 1990s US stock bubble showed that 78% of retail investors bought stocks because of a friend's recommendation, while only 12% said they read the company's financial report. Why is word of mouth so effective? Because it comes with a filter of trust. A friend's word is more credible than an unknown expert's, and it carries emotional contagion. For example, a friend says they made money buying a iStocks and offers to let you in on the action. You feel like you're not speculating but making money with a friend, lowering your guard. Shiller warns us that word of mouth is the viral vector for bubbles. One profit story can spread to 10 people in a week, those 10 to 100, and eventually the whole population is infected. After examining psychological anchoring and herd behavior, we can grasp a harsh truth. It's not that the bubble tricked us. It's that our human nature is easily tricked by the bubble. The media amplifies emotion because we love hearing success stories. New era thinking brainwashes us because we want to believe this time is different. Herd behavior explodes because we fear isolation and losing out. These human weaknesses are the most fundamental pathology of the bubble. But this raises a question. If human nature is so irrational, why do some say the market is rational? For instance, the efficient market hypothesis claims stock prices reflect all information, making bubbles impossible. This completely contradicts the human weaknesses we see. In the next section, we will deconstruct this rationality myth. Where exactly does the efficient market hypothesis go wrong? Why can't it explain the 1987 crash or the 2000 dot-com bubble? Understanding this is essential to fully realizing that a bubble is not a market anomaly, but the inevitable result of the combination of human nature and market mechanisms. In our last section, we fully uncovered the human roots of bubbles. Psychological anchoring makes us misjudge prices, and herd behavior makes us blindly follow the trend. These human flaws push the market towards a frenzy. But at this point, some people will surely object. Wait a minute. There are astute investors in the market. They will correct mispricing, so how can a bubble exist? Others argue that investors learn from their mistakes. They will learn from a bubble and not repeat the error next time. In this part, we'll respond to these two rationalist viewpoints. First, we'll debunk the myth of the efficient market hypothesis, and then we'll reflect on, do investors truly learn? After this, you'll realize the market is far less rational than assumed. And investors' learning is often just a case of healing the wound, but forgetting the pain. It is this very irrationality and limited learning that necessitates discussing how to proactively cope in the next section. Part 1. The efficient market hypothesis. The rationality myth debunked by bubbles. When discussing market rationality, we can't avoid the efficient market hypothesis, EMF, the standard answer in many finance textbooks. Its core claim is simple. Stock prices already reflect all available information, so bubbles cannot exist. This is because astute investors will quickly correct mispricing. For instance, if a stock is overpriced, smart investors will short sell it until the price returns to a reasonable level. If it's undervalued, they will buy, pushing the price up. It sounds plausible, but Shiller uses 140 years of market data to punch holes through this myth. The strongest logic of the EMH is that stock price volatility is determined by earnings volatility. If a company makes more money, the price rises. If it makes less, the price falls. But Shiller's statistics show that stock market volatility is more than 10 times greater than the volatility of corporate earnings. This isn't reflecting information. It's emotional chaos. The most typical example is the U.S. stock market in 1929. From 1928 to 1929, U.S. corporate earnings only rose 10%, yet the Dow surged 50%. From 1929 to 1932, earnings dropped 50%, but the Dow plummeted 80%, a multifold difference in volatility. The 2000 dot-com bubble was even more exaggerated. From 1995 to 2000, U.S. tech company earnings only grew 30%, but the NASDAQ index rose fivefold. From 2000 to 2002, earnings dropped 20%, but the index crashed 78%. This is hardly reflecting information. It's an emotional roller coaster. The EMH claims there's no significant mispricing, but Shiller found numerous counterexamples. The most classic are the tech stocks during the dot-com bubble and the closed-end fund discount puzzle. Look at the dot-com bubble in 1999. Netscape went public without yet turning a profit, but its market value soared to $3 billion. Amazon was losing $100 million annually at the time, yet its market value surpassed the reliably profitable Walmart. According to the EMH, investors shouldn't pay a premium for a losing company, but in reality, everyone scrambled to buy. Shiller interviewed fund managers at the time who confessed, "I know these companies aren't profitable, but everyone else is buying. If I don't, my clients will complain." This is not rational correction. It's following emotion. Now consider closed-end funds. They raise capital once, have a fixed number of shares, and can only be traded on the secondary market. Logically, their market value should equal the net asset value of the stocks they hold. But in reality, many closed-end funds trade at a discount of 10 to 30% below their net asset value, and sometimes even a premium, clear mispricing. The EMH argues that astute investors would buy discounted funds to arbitrage the difference, forcing the price back to net asset value. But Shiller found that arbitrage costs are very high, such as the difficulty of borrowing shares and expensive transaction fees. Astute investors are unable to correct this error, and the discount can persist for years. There's an even more heartbreaking example: the 1987 U.S. stock market crash. The Dow fell 22.6% in a single day. But there was no major negative news that day. No war, no economic crisis, no major corporate scandals. According to the EMH, no new information means no major volatility, yet the crash happened. Shiller's post-event survey found that 60% of investors said they sold stock because they saw others selling, not because of bad news. The EMH simply cannot explain this purely emotion-driven volatility. Another key assumption of the EMH is that astute investors can correct errors through short selling. But Shiller found that in reality, short selling is heavily restricted, making it impossible to correct bubbles in time. For example, short selling requires borrowing shares. You must borrow stock from a brokerage to short sell. During a bubble, everyone is bullish and brokers have no shares to lend. Even if you manage to borrow them, the cost is very high. During the 1999 dot-com bubble, the cost to short sell a certain tech stock was as high as 20% annually. Even if you knew the price would fall, you couldn't make a profit. Furthermore, Many countries impose naked short selling bans, restricting the act of short selling before securing the borrowed shares, which further limits the ability to correct. More importantly, the power of market sentiment far exceeds that of astute investors. During the 2000 dot-com bubble, a few astute investors short-sold tech stocks, but ordinary investors' frenzy of buying pushed prices higher, causing the short sellers to lose everything and eventually be forced to cover their positions at a loss. This is not astute correction. It is emotion-crushing rationality. Shiller says this is like standing in front of a flood and shouting, "Stop rising, it's useless." The emotional torrent of a bubble cannot be held back by a few smart investors. Part 2. Investor learning and forgetting. Can we really learn from our mistakes? The rationalists have another point. Investors learn from bubbles and won't repeat the mistake next time. For example, people feared the stock market after the 1929 crash, and they feared tech stocks after the 2000 bubble. This is learning. But Shiller uses historical data to prove that investor learning is limited, even temporary. Before long, they forget and then they repeat past mistakes. Shiller's most classic research is on the change in investors' perception of stock market risk. Tracking investors from 1989 to 2004, he found that people's perception of risk completely follows the market. They feel risk is low during a bull market and high during a bear market. They learn nothing about long-term risk from historical bubbles. For example, during the 2000 US stock bubble, 87% of investors said long-term stock holding was risk-free because it had been rising for 5 years. But after the 2002 bear market, 62% of investors said the stock market was too risky and they would never touch it again. This is not learning. It's judging based on the current market. More ironically, after the 1929 crash, people feared the stock market for 20 years. But by the 1950s, they forgot the pain of that year and believed the stock market would rise forever. After the 2000 bubble, people feared tech stocks for 5 years. But by 2015, they were frantically buying tech stocks again. This short-term memory doesn't constitute true learning. Rationalists often say that in the long run, stocks outperform bonds. So buying stocks is not wrong. This is the equity premium theory. Many investors treat it as gospel, believing they won't lose money as long as they hold for the long term. But Shiller busts this myth. Stocks outperform bonds is not always true. It depends on the timing of the purchase. If you buy during a bubble, you can still lose money long term. Shiller calculated US data from 1871 to 2004. If you bought stocks at the peak of the 1929 bubble, you would wait 29 years to break even. If you bought at the 1966 peak, you would wait 26 years to break even. Even if you bought at the 2000 peak, you only barely broke even by 2013. This is hardly outperforming bonds. It's clear long-term entrapment. Shiller says this is because investors only look at the most recent bull run while ignoring long-term risks. This selective learning is more dangerous than no learning at all. Rationalists also argue that investors learn to reduce risk through diversified investing, such as allocating funds to bonds and cash instead of putting all money into stocks. But Shiller found that many investors learn the concept but fail to apply it, still putting all their eggs in one basket. For example, during the 2000 dot-com bubble, 60% of retail investors put over 70% of their money into tech stocks, with no allocation to bonds at all. This isn't an inability to diversify. It's being emotionally overwhelmed, believing that diversifying means missing out on profit opportunities. Another common misconception: buying multiple stocks in the same sector constitutes diversification. For example, buying 5 AI stocks and thinking the risk is spread out when, in fact, they rise and fall together, and the risk is not reduced at all. Shiller says this is because investors haven't truly grasped the essence of diversification. They've only learned a superficial form, and they repeat old mistakes when they encounter a bubble. After reviewing the rebuttal of the efficient market hypothesis and the reflection on investor learning, we can draw two key conclusions. First, the market is not completely rational. A bubble is the inevitable result of human weaknesses combined with market mechanisms. Do not count on astute investors to correct errors, and do not think the market will automatically return to rationality. Bubbles do not disappear on their own. They require proactive coping. Second, investor learning is limited, and people easily heal the wound but forget the pain. Do not think that having suffered a loss once means you won't repeat it. You must establish systematic coping strategies, such as diversified investing and planning, rather than relying on spontaneous decisions to avoid bubbles. In the next section, we will discuss exactly what to do. For the individual, how can one avoid buying high and selling low, chasing gains and cutting losses? And how should one allocate assets? Shiller's core advice is simple. Since the market is irrational and human nature has flaws, we must use rational systems to combat the irrational market and use clear plans to constrain our impulsive selves. This is the fundamental way to deal with bubbles. We've thoroughly discussed how the essence of a bubble is the result of a combination of human weaknesses, market mechanisms, and cultural soil. Since the market is irrational and human nature is hard to change, how should ordinary people cope? Shiller's advice is not to predict when the bubble will burst, but to establish rules for coping with it. To use rational methods to fight the irrational market, and use clear plans to restrain your impulsive self. For individuals, stop being led by emotion and use disciplined, systematic methods to avoid pitfalls. For us ordinary investors, the core of coping with a bubble is not about perfectly timing the exit at the peak, but about avoiding chasing highs, over-concentration, and blind conformity. There are 3 actionable methods we can implement. First, use the Shiller PE ratio to judge valuations, and don't let the most recent price be your anchor. As we mentioned before, the Shiller PE is the price divided by the 10-year average of earnings, which helps smooth out short-term earnings volatility. For example, the overall Shiller PE for the A-share market is currently around 18 times, which is below the historical average of 20 times and still reasonable. However, hot sectors like AI and new energy have PE ratios over 50 times, clearly detached from earnings. At this point, don't join the chorus shouting, I will rise forever. You must know that hot sectors may have a bubble. Ordinary people don't need to calculate this themselves. You can find the Shiller PE for various markets online. A quick glance tells you if the current valuation is expensive, which is far more reliable than listening to your friends. Second, overcome herd behavior and don't use others' profits as your own reason for decision-making. The Ash experiment showed that 33% of people follow the wrong answer, and the same is true for investors. For example, if a friend says they made 20% on an AI stock, don't immediately follow the trend. First, ask yourself, is this company truly profitable? Do I understand this industry? Shiller's research found that 80% of people who followed the crowd during the late stages of the bubble eventually lost money because they were buying emotion, not value. If you're unsure, just remember, what everyone is scrambling for is usually not cheap. This applies to the previous lottery-allocated housing and today's hot stocks. Blindly jumping in will likely make you the last buyer bag holder. Third, practice true diversified investing, and don't put your eggs in one seemingly diversified basket. Many think buying 5 AI stocks is diversification, but since they rise and fall synchronously, the risk is not reduced. True diversification is across asset classes and across markets. For example, allocate 40% to stocks, don't buy only hot sectors, 30% to bonds for stable returns, 20% to cash for emergency needs, and 10% to foreign assets, such as a U.S. stock index fund. This way, even if the E-share market falls, the bonds and foreign assets might rise, which hedges risk. This is the most effective safety cushion against a bubble. We must also add one more rule. Establish a mandatory savings plan, and don't mistake paper gains for savings. As mentioned earlier, after the 2000 U.S. stock bubble burst, many people realized that all their previous gains were illusory. So, regardless of whether the stock market is rising or falling. Save a fixed amount every month, say 10% of your income, into a low-risk account. Don't rely entirely on stock market appreciation for retirement. After all, investing is for a better life, not a gamble. Shiller concludes in his book by saying, "I can't predict when the bubble will burst, but I know the best way to deal with it is not to be swept away by it." For us, investing is not about betting who can make the most in a bubble, but about how to avoid suffering devastating losses in one. Remember, use the Shiller PE ratio to judge valuation. Don't follow the trend. Use diversification to hedge risk. Don't be greedy. Use mandatory savings as a foundation. Don't rely on paper gains. This way, no matter how crazy the market gets, we can maintain the financial confidence to live our lives. This is the ultimate answer to coping with bubbles. Congratulations on finishing another book.